Hello and welcome to today's Horizontally Minerals session. Throughout this, all participants will be in listen-only mode, and afterwards there'll be a question and answer session. And just to remind you, this is being recorded. So today I'm pleased to present Jeremy Martin, CEO, and Simon Retter, CFO. Gentlemen, please begin.
Good morning. Thank you for all dialing into the call. We're going to talk through the presentation and really cover today's announcement on the royalty financing. So starting on page 4, we're very pleased today to announce this royalty financing with Orion. It is a $25 million upfront cash payment secured to the Araguaia ferronickel project for a 2.25% royalty. A couple of key features of this structure is the royalty is only applied to a set amount of nickel produced from the project. In this case, it's 426,400 tons, which is the stage 1 single line production scenario featured in the feasibility study. So any nickel produced above that amount, the royalty does not apply. One of the key attractions in working with Orion, they are one of the largest private equity groups in the mining space. They currently have over $5 billion under management, and we see this as a building relationship with Orion. And I think this demonstrates the quality of the Araguaia project. Orion have gone through a fairly rigorous technical and legal DD process, similar to the one that the banks will be undertaking. And obviously the investment is testament to that process. The other key thing about a royalty, I mean, one of the areas we're concerned about as management is obviously dilution to existing shareholders. The company has been trading at low share price levels for the last 12 to 18 months, so we've been very conscious about not diluting shareholders, and this is why the royalty is so attractive. It's a non-dilutive funding mechanism, and effectively this financing would be equivalent to raising equity at 10p. This is the main building block now and a catalyst we see to building value into the company as we move into the project finance stage. Just a refresher on the key overview of the company on page 5. Obviously we've got 2 assets, both 100% owned, both in the same district. Araguaia, the advanced ferronickel project, which the royalty is applied to. If we look at the headline numbers there, and we'll focus on these a bit further on the presentation, but nickel has increased significantly, and it's worth remembering that our base case in the feasibility study was $14,000 per ton nickel, and today nickel price is $16,200, and at those levels the NPV of the project is around $600 million, giving you a 26% IRR. It's also high grade and it's scalable. So Araguaia, the initial 10 years of the mine life is around 1.9% nickel, and it's designed to bring a second stage in to double that production capacity. We're fully permitted, and the other part of this story is we're not a one project story. Our second asset, Vermelho, which is within trucking distance of Araguaia, there's a pre-feasibility study underway on that project, and that's designed to provide sulfate for the battery market. So we have a robust portfolio, and the other key part of this story is nickel, and nickel really has performed well over the last 6 months. Looking at the district that we're in on page 6, this demonstrates our scalable production scenario. And if you look at the map on the right-hand side, Araguaia is shown on the lower section of that slide in blue, the stage 1 and stage 2 production scenarios, with stage 1 producing around 14,000 tons, being able to increase that up to just under 30,000 tons per year of nickel. In the center of the district, which is shown by the ANN symbol, that's the cluster of assets we acquired off Glencore. And then to the north of that district in red, we've got the Vermelho project. And this is all within trucking distance, so each deposit is intertruckable. We now have the ability to build out a total nickel production capacity of around 50 to 60,000 tons per nickel a year. And if that was to be delivered, that would put you within the top 10 nickel producers worldwide. So this is a very unique portfolio that the company owns and is developing today. Slide 7 just shows our resource growth over the last 6 or 7 years. And you can see from our initial discovery, grassroots discovery back in 2010, we have increased that resource base by over 800%, and that's acquisition from a number of the tier 1 major companies around us. You can see the names Teck, Glencore, Valley, and discovery and drill out of what we have in our own resource base. So it's been a pretty significant resource growth over that period. Now, a key part of this story is nickel and what the nickel market's doing, and it's all about nickel today and the future growth in that arena. And we have 4 or 5 key factors that are significant around nickel and make it so compelling. Number one, the nickel stocks held globally. That's on the LME and the SHFE in China. Currently today, we're around 140,000 tons of inventory. And that's come down from just under 500,000 tons 5 or 6 years ago. So we've had a steep drawdown in nickel stocks. Demand for stainless steel is running about 5% year on year, and we're going to see that grow. And then we've had this new phenomenal growth from the electric vehicle battery market, and there's a requirement for anywhere over 1 million tons of new nickel by 2030, 2040. So that's on a production base of 2.2 million tons of nickel today. That's a very big step up in demand. And the other thing is, because the nickel market has been depressed for the last sort of 10 years, there's been very little money has flowed into the development of new projects. And on average, any new nickel, big nickel mine will take 8 to 10 years from first permitting through to ramp up. So there's going to be supply side constraints, and this is where we are so well positioned. Stainless steel is the main dominating demand driver in the nickel space today. It accounts for about 70% of all nickel consumed. And you can see that pie chart on the right, how the EV battery market's going to start to expand into that space. But our focus today is the Araguaia project, which is going to produce ferronickel to go into the stainless market, and we see that for the midterm being the driver that we're focusing in on. And then if we look at the EV battery market, there isn't a day that goes past where there isn't an article in the press about some element of the EV story. It's not just cars, it's effectively every form of transport is being looked at, from urban transport through to boats, planes, etc. So going forward, it's going to be a major part of the nickel story. And you can see there's a raft of demand numbers out there, but there's approximately 3 million vehicles on the roads today, and that number's due to increase to around 40 million by 2030, and that means we need over 1.2 million tons of new nickel. And if you think Araguaia is going to produce 15,000 tons, that's a significant amount of new projects required. Slide 12 just shows some of the main banks' price forecasts, and you can see there numbers ranging from the low end, 16,000, up to 21,000. Please just remember that our base case on Araguaia is 14,000, and today the price is 16,200. A quick refresher on Araguaia: we released the feasibility study late last year. If you look at our base case, which is on the right-hand side of that table, but I think it's worth focusing on really the area in red, which is showing the net present value of the project at today's nickel price. And the net cash flow after payback of capital is 2.3 billion. It generates an IRR of 26% and a net present value of over 640 million. And a key number is the cash cost, around just under $7,000 a ton. So it will be one of the lowest cost producers out there. And then if you look at the map on the next slide, that just shows the design of the process plant. Stage 1 is shown, and the area to the top of the slide, which has got a blue boundary around it, is where we can insert and construct the second line to double capacity. And in that double stage 2 expansion, the net cash flow goes up to 3.6 billion, 30% IRR, and the net present value is 1.1 billion. So that is a big step up in terms of the economics. Page 17 is the cost curve. It's all about being in the lower quartile. And if you take all of the global nickel laterites, you can see there are year 1 to 10. Costs will be around $6,600 a ton, which places us right in the lower end of that cost curve. Simon will talk about the capital funding.
Yeah, so the capital cost for stage 1 is 443 million. There's obviously a large portion of that is utilities and infrastructure, which includes the power line. Stage 2 capital cost is about 200 million.
In terms of where we're currently at, from the second quarter this year, we've been focusing on the project finance package for Araguaia. Obviously, today's announcement is the first step of that process, announcing the 25 million non-dilutive financing royalty with Orion. We're also in discussions with a number of the project finance banks. We're working with Endeavour Financial on that. We've currently got 7 active groups, a mix of international and local. And as we move into the second half of the year, we expect to advance that process with the aim of having the complete project finance package in place by Q2 next year, so we can start full construction. I think the key messages that we're getting from these project finance banks is there are very few mid-capex projects in the market, and they're all looking to get exposure to nickel. And obviously, having seen the price increase over the last 3 to 4 months, I think that appetite will continue. Just very quickly looking at the Vermelho nickel cobalt project. This was an asset that we acquired off Vale around 14 months ago. Why we like this project, it's a very high-grade scalable resource. It's within our district. It's within trucking distance of Araguaia. Vale had undertaken a full feasibility study and actually given this the construction go-ahead. We estimate they've spent over $200 million, very high-quality work. We are currently in the final stages of a pre-feasibility study on this project, and the aim is that we will show a lower capital cost project, and we believe the economics are going to be compelling on this asset. And the key thing is this allows us to service the complete nickel space. Araguaia producing ferronickel for the stainless market, and then Vermelho producing nickel and cobalt sulfate that we can sell into the battery space. Page 22 just really highlights the quality of Vermelho, and this is a grade tonnage curve. These are fairly standard metrics, and it's really showing our peer group and showing the grade of the asset and the amount of contained nickel. And you can see there on either metric, Vermelho sits at the upper end of this table, so it's high grade, and it's got over 1.6 million tons of contained nickel, which is significantly larger than its peer group. This is the pathway of development for Vermelho. We obviously completed test work earlier in the year to demonstrate we can produce battery-grade product. The pre-feasibility study will be out in the second half of the year. That's in the final stages, and we're also advancing the permitting. So it's going to be an exciting time around news flow from this particular project. So really, just to conclude, Horizonte provides investors with direct exposure to the nickel market. We have Araguaia is a robust asset. It sits at the lower end of the cost curve and returns some pretty compelling economics at the current nickel price today. We're well funded. Closing this royalty, we'll have around $30 million in the company, and this allows us to move forwards with the early works packages on Araguaia. Another key thing is location. We're in one of Brazil's premier mining districts, the Carajás district. We've got good infrastructure, good proactive support, and lastly, scalability. We have now in our nickel portfolio between Vermelho and Araguaia over 4 million tons of contained nickel, and we have the ability to build out over time a 50 to 60,000 ton a year nickel business. which is all 100% owned. The final slide is just a corporate snapshot showing key shareholders, and that's also important to mention. We have Tech Resources owning 14% of the company. We've got Glencore as an active shareholder, and also we have a number of London institutions, the likes of Canaccord, JP Morgan. So this is a good, strong shareholder base to allow us to advance the company going forwards. So that is the end of the corporate presentation. We're happy to take any questions that people may have.
Thank you. So, ladies and gentlemen, if you're on the phones and you wish to ask a question, please can you press 0 and then 1 on your phone keypad now in order to enter the queue. And then after I announce you, just ask that question. And if you find that question has been answered before it's your turn to speak, just press 0 and then 2 to cancel. So our first question is from the line of Justin Chan at Numis. Please go ahead, Justin. Your line is now open.
Morning, Jeremy. Congratulations on getting the deal away. My first question is just on the details of the royalty. I presume for the nitty gritty of it, the 2.25% is applicable on the net smelter revenue. Is that correct, or are there any other elements of the calculation that are worth noting?
It's actually a gross revenue royalty minus freight, so that's the way it's calculated, and insurance.
Okay, and is payability, so is that on the, and that's on, I guess, is there a payability assumption on it, or?
Yes, so it's payable on the nickel priced of the LME price.
Right. Okay. So that would, okay.
So the iron credits have not been included.
Okay. I guess what I'm trying to understand, is there any payability deduction at all, or is it just the nickel volume times the LME price?
Exactly, nickel volume times the LME price minus freight and insurance.
Okay. Perfect. And then just, I guess my next one would be on the other work streams regarding financing. I guess what if any update can you share with regards to the state of negotiations with potential project partners and with debt providers? I know you touched on it a little bit earlier, but I guess from a timeline perspective or just from a color perspective, maybe if you could just give us a bit more of an update there.
Yeah, absolutely. So in terms of the project finance, the debt providers, obviously we're working with Endeavour on that process. We have 5 of the main European North American banks active in the process and 3 of the Brazilian banks. Obviously this royalty is a catalyst to that process. And as we move into the second half of the year, the aim is, as we draw towards the end of the year, we'll be moving into a position where we're starting to mandate those banks as we move into Q1, with the aim of having the debt piece in place by the end of Q1 into Q2. So I think that process will move fairly quickly. We've also had discussions and have open discussions with off-takers, and we've got interest on that side, and you will see that move in and advance in the second half of the year as well.
Okay, and is there any, at this stage, is there any hedging, and also I guess keeping in mind the nickel prices run quite a lot, is there any hedging requirement that you foresee with regards to the debt, and is that, I guess, has that come up in negotiations?
No, it's Simon here. No, it hasn't at this stage. We understand that there may be some hedging required, but given the nickel market and a lot of the pricing is actually done off market, we're not expecting there to be significant amount of hedging. It will probably be undertaken from just from an offtake, take or pay offtake.
Okay, and then just on Vermelho, could you give us an update on timing there for the PFS, and is there any movement on the kind of expected parameters, or is 15,000 to 18,000 tons where you expect to be from a production rate? Just could we get more color on that workflow and both timing and scope?
Yeah, absolutely. So as I alluded to, the PFS is in the final stages of preparation. So we're aiming to have that out towards the end of this quarter. The production nameplate will be sort of towards the upper end of those numbers that you've discussed. Capital cost, again, is sort of within the broad targets that we outlined to the market. I think it will be a well-received study. And there's obviously been a lot of historic work that we've been able to draw on, and our focus has really been to optimize the resource to come up with the highest grade 20 to 25-year mine life, and the most beneficial flow sheet with where the market's at, i.e., do you produce sulfate or do you produce intermediates?
Okay. And in terms of that last part, where's the current thought process?
At the moment, we're looking at the sulfate route, but you will have the option, if that market changes, to produce or stop at the intermediate. I think what we're seeing at the moment is it's quite a fast-moving market, and I think you will evolve that as you move into feasibility study.
Okay. And I guess in terms of the new resource that you announced, is that expected to come into the plans for either Araguaia or Vermelho, and should we look for that in the PFS, or is that probably a later workflow? I
think if you look at Araguaia, the stage 2 model operates from the existing resource base without that new resource that we released from Serra da Tapa. But the upside case would likely involve some more from Serra da Tapa in the Vermelho PFS. That's an option that we're looking at.
Okay. Perfect. Thanks. I think that's it from me for now, but thanks very much, and both congratulations, and we're very much looking forward to the PFS on Vermelho.
Thanks very much.
Okay, our next question is from Shard Capital and Simon Leathers. Please go ahead. Your line is open. Simon, you may want to take your phone off mute.
Oh, apologies. I was just confirming that the initial 443 capex was sufficient. That is sufficient to cover the stage 2 development. Presumably, the second line is funded from organic cash flow.
Correct. Yes. So the upfront capital cost of 443 would remain the same, and as soon as ramp up and cash flow positive production, then we would look to reinvest all of the proceeds into stage 2. But the timing of that is obviously to be confirmed.
Okay, understood.
And the second stage capex is slightly, I think it's $199 million, because a lot of the infrastructure and utilities and site works has already been factored into the stage 1 capital cost to make allowance for the second line being built in.
Yeah. Okay, thanks.
Our next question is over to the line of Michael Stoner at Berenberg. Please go ahead.
Morning. Just following on from one of your comments on offtake, is there any potential there for a prepayment, or is it just take-or-pay agreements to give you kind of revenue or sales certainty for the debt providers?
Morning, good to speak to you. I think there's pros and cons to each of those, and obviously the take-or-pay is a common route, and that's the route we're going to be pursuing. The prepay has additional challenges with it. So I think they would both be available, but we obviously want the most beneficial option for what we're doing, which is most likely going to be the take or pay.
Okay, understood. And then just more widely on the financing strategy here, given relatively low combined royalty rates on the project, is there any more potential for expansion of a royalty? And then what level of debt do you think the project can wear? You've talked to 60 to 65%, but in the past some projects have gone a bit further than that. So are we kind of expecting a debt package of $265, $280 million, or maybe a little further if you're able to discuss that yet?
I think firstly on the royalty, this was part of a process, and we had a number of groups active in this process, and I think there is room to, whether it's with Orion or another, I think there's room to look at additional options on royalties going forward. As I say, this is only on the stage 1 at this stage. So yes, that is something we will look to expand going forwards. In terms of the debt capacity of the project and the levels, I think the levels that you've discussed are sort of where we're going to be targeting.
Okay, perfect.
Right.
Yeah, no, that makes sense. And then finally, following on from Simon's question, do you think, given a relatively robust outlook for nickel that you've discussed, do you think there's potential to add a little bit of debt once you're de-risked in production, generating positive free cash flow, that would allow you to accelerate that $200 million investment, or would you rather than just fully fund that out of cash flow and wait a little longer?
Yes. So that would obviously be a route to accelerate it, and we would look to do that potentially as part of a refinance once we got through the initial construction as well, to take advantage of potentially some cheaper debt.
And I think the other thing is what's the nickel price doing? I mean, we obviously modelled this at 14. It's 16.2 today, so it all comes down to what nickel price is doing at the point in time. But yes, there's definitely room to take on some additional debt at that point if that was where we were heading.
Perfect. That's all from me. Thank you very much for your time.
Thank you.
Okay, the final question for today is over the line of Phil Swinton at Shard Capital. Please go ahead, Phil. Your line is now open.
Thanks. Hi, Jeremy. Great news. Congratulations. Just a couple of questions. Just firstly on the mechanism of the royalty. Is there a buyback clause in there? So a right to repurchase percentage of the royalty after a set number of years, anything like that?
Yeah, Phil, good to speak to you. Yeah, there is a mechanism in there. There's the ability to buy back 50% of the royalty.
Okay, does that kick in after a certain anniversary of the proceeds being delivered?
There are a number of different triggers that can be exercised on.
Okay, fine. And also, could you just give us a bit more information on the use of proceeds for that 25 million on the run up to full construction? And do you think most of that will be spent by the time you push the button on the build?
Yeah, that's a good question. So this is obviously designed to cover the early works package. So what does that mean? First of all, it allows us to bring the construction team in, and you'll see that roll out fairly quickly going forwards. It allows us to take the project from feasibility stage through into basic and detailed engineering. It allows us to move forwards and acquire the land packages and effectively start upgrading the infrastructure into the project, and really allows us to run seamlessly through the project finance process and into construction. So in answer to your question, yes, it all goes into moving the projects forward from this point.
Okay, perfect. That's all from me. Well done.
Thanks very much.
So I apologise, we do have a final question, and that is a final one from back to the line of Justin Chan at Numis. Please go ahead.
Hi, everyone. Sorry to keep you on the line for one more, but just on the terms of the buyback, are you able to share with us what the, what the price on the buyback is, and I guess when it applies?
They are effectively confidential terms which are structured in the agreement, but we can talk offline and follow up on that.
Okay, all right. Thanks very much.
Thank you.
Okay, so gentlemen, may I please pass it back to you for any closing comments at this stage?
No, I think we've covered most of the areas today. Obviously, as we've discussed, there's going to be a number of news and project milestones over the next quarters, and we look forward to keeping the market updated. Thank you very much.
I'll conclude today's session. Thank you all very much for attending. You can now disconnect.